Welcome. My name is Filiz Unsal. I am an economist at the International Monetary Fund. It's my pleasure to be chairing the third and the last of the event series on central banking and inequality, organized jointly by the Peterson Institute of International Economics, Council of Economic Policies, and the IMF. The first two sessions covered the links of financial policy and financial market infrastructure with inequality, and recordings of these sessions you can find at the Peterson's website. And today we will discuss perhaps the most obvious function of central banks, the monetary policy. Widening inequality in advanced economies and in many emerging markets have been a major concern in years running up to the current crisis, but massively exacerbated by the COVID-19. The pandemic and the efforts to control it have disproportionately hurt the poor, low-educated workers, women, youth, and those who were already living on the margins of society. Left unchecked, these growing disparities will perhaps lead to long-lasting, severe scarring, so policymakers must act. So when we talk about inequality, we tend to think that fiscal and structural policies are the first line of defense, as discussed in Peterson event in 2019. But it is perhaps necessary to consider the whole package, including monetary policy, interactions with other policies, as well as in innovative solutions. Now, recent research suggests that monetary policy can impact inequality at different levels, but the distributional effects of monetary policy are complex. And in turn, inequality affects the transmission mechanism of monetary policy. This perhaps explains growing attention of central bankers to the topic. From Janet Yellen to Mario Draghi, they all talk about inequality in some shape or form in recent years. So should monetary policy makers care about inequality? And if so, how? And how the COVID-19 pandemic is shaping the policy thinking and practice on the issue. I would like to welcome our very special panelists today. I am in incredible company and very honored to welcome Olivier Blanchard, Senior Fellow at Peterson Institute and Professor of Economics at MIT. Olivier was also the Director and Economic Counselor of the IMF from 2008 to 2015, and I was fortunate enough to work with him for a couple of years as a Director of Research Department. And we have also Markus Brunnermeier, Professor of Economics at Princeton University, Adam Posen, the President of the Peterson Institute of International Finance, and the Honorable Tharman Shanmugaratnam, Senior Minister in Singapore Cabinet and the Chairman of the Monetary Authority of Singapore. Welcome to all of you. I wish I could see you in person, but I'm sure we are going to have a very productive discussion. Markus, I would like to start with you. You had a Jackson Hole paper in 2012 with Uliv Sanikov on redistributive monetary policy, and you continued to extend your research further on this topic. So maybe you can tell us a little bit about what are the theoretical channels through which monetary policy may have an impact on inequality, and what does the evidence say? Is there any change in our thinking regarding the impact of COVID-19 on these transmission channels? So the floor is yours, Markus.
Thanks a lot, Filiz. It's an honor to be on this panel with all the other panel members and with you, and giving me the opportunity to present my thinking. So, of course, I think monetary policy has implications on redistributive matters, on income inequality and wealth inequality. And when you cut the interest rate, of course, you help people who have a credit card debt, and you stimulate the economy, boost unemployment, and that's actually beneficial for the poor people. But on the other hand, it also creates higher stock prices. So we have to think about this. I think what's important to understand is that actually there are two channels, and it goes in both directions. So on the one hand, monetary policy is affecting inequality. On the other hand, inequality is also impacting monetary policy. So it goes in both directions. So let me first focus on the fact where there is redistributive monetary policy. And that's, you know, the paper you mentioned, that's what we focused on. To what extent does monetary policy itself affect inequality later on? And is it desirable in what sense? And within this class, there are actually two ways that monetary policy can affect and wants to affect inequality. And one is to stimulate consumption. And for example, you want to shift wealth from rich, low marginal propensity to consume households to poorer, high marginal propensity to consume households. So this way you can manage your aggregate demand better. So that's essentially focusing very much on the consumption aspect. So if you think about the main decisions, one is the consumption aspect. The other main decision for households is the portfolio choice. And if you look at the consumption choice, this shift from rich households with less marginal propensity to consume to poor households with a higher marginal propensity to consume, that's for demand management of consumption. The other choice is a portfolio choice. The portfolio choice is, you know, how much risk people take and how much they want to save in a safe asset and money and government bonds and all that. And that depends very much on the risk environment. And it could be that certain sectors or certain households, certain investors balance sheet impaired. And that's, you know, think of the household sector in the great financial crisis, they were balance sheet impaired, and you want to shift wealth into this household sector in order for them to balance the balance sheets again. But it could also be certain industrial sectors, certain industries, banking sector and so forth, which are balance sheet impaired. And you would like to shift wealth towards this sector in order to bring the price of risk down, reduce risk premia, and stimulate investment. And by stimulating this investment, you essentially create more jobs and you stimulate the labor market as well. And that in turn then lowers inequality down the road. So it goes in both directions in the first place, and then within the direction where monetary policy tries actively to influence inequality in order to stimulate either consumption demand or change the portfolio choice away from the safe assets towards more risky assets, so more investment essentially. The other direction it goes as well, the other direction, if there's a lot of inequality, and inequality could be one driving factor why our star is so low. And if we lower our star, that means we are closer to the zero lower bound or the effective lower bound. That limits monetary policy. So inequality on the other direction is also affecting monetary policy. So it goes in both directions. I think that's the main thing to take away from it. The second thing is I would like to mention, how would you do it and how does it work? And typically, the way redistributive monetary works is through relative asset prices. You make certain asset prices more expensive and others less expensive. So for example, if you have an interest rate cut, of course, you make the long-term bond more valuable relative to short-term bonds or, you know, money in a sense. And this change in wealth then actually makes a big difference, because you change asset prices, relative asset price, and depends who is long, who is short. So who is holding certain assets and who is not holding certain assets. And you can do this now with unconventional monetary policy. You can affect many more prices, not only the short-term interest rate, but you can also affect term spreads, so the difference between short-term and long-term interest rates. You can affect credit spreads, risk premium, and all this. And depending what spread you affect, you will benefit different investor classes, different households, and that gives, of course, the central bank a lot of power. And many people are reminded of the 1970s, where they say, okay, the central bank had so much power, it could grant even credit to certain subgroups. That's actually, you know, goes beyond the political mandate. And that also undermines, to some extent, potentially the independence of central bank, because central banks, you know, are not supposed to do a lot of redistributive monetary policy, even though any monetary policy does redistributive monetary policy. And that's, I think, the big challenge we are facing more generally. So you also ask, you know, should we care about inequality? I think for sure. I think we have a very narrow view often that we care about price stability and all this. But of course, first of all, we should care about the society's welfare, and that includes social cohesion and other aspects. But we have to be very careful to stay within a clear mandate and be, you know, make sure that it stays within this fairly clear mandate: price stability, economic growth, and financial stability, and how it translates it. And there are many channels where it actually does impact economic growth, as I've just outlined. Now, for the final part of your question about COVID, is it special? After what have you learned about COVID? And for me, the biggest lesson from COVID is it's not all about efficiency, it's also about resilience. So that's for me the biggest lesson. And to what extent, we can bounce back. It's not only, minimize all the costs, but to what extent we can bounce back. And for this, monetary policy is very important too, avoiding scarring effects and all this. And that has inequality aspects as well, because it helps the poor if the scarring effects are avoided. So that's my first take on this topic.
Thanks a lot, Markus. No, this is very important, and your point on resilience is very important, as we see that the countries that are more vulnerable to external shocks are experiencing much more volatility in this current pandemic. So I would like to move to Adam. Adam, so the Peterson has been actually very actively working on this topic of inequality, and you personally contributed to this debate in various occasions. So what is the scope in practical terms for monetary policy making to take inequality into account, given a typical mandate? Do you think that is this feasible, or central bankers are moving in the right direction in that aspect? Adam?
Thank you, Filiz, and thank you again for your partnership with David Wilcox and our team here in creating this series of events. I think it's great to start with mandates because it's a good wake-up call on political economy of central banking. And Markus also mentioned mandates. And I did some research, which is now old but still relevant, that mandates actually have almost no predictive power for the behavior of central banks. So the example I always give is that the Swiss National Bank had some incredibly detailed contingent mandate that almost got into chocolate prices. And yet it had basically the same behavior for much of its history as the Bundesbank that had, a very simple price stability target. Similarly, people who've done Taylor rules and various reaction function estimates for central banks find a lot more similarity than what the mandates would tell you. So I don't want to suggest that legal mandates don't matter, that they are very important, but in practical terms, what we don't need to get too caught up in the language of mandates. What I do think is important is that central banks recognize, as I think they mostly do, that they are independent through the tolerance and the political environment that surrounds them. There is a tendency, going back, that I've been writing about for more than 25 years, to sort of assume that central bank independence was this gift from God or from Ken Rogoff, that you just, it's a solution to a problem, which is the inflation bias and time inconsistency, and you just do it and you're done. But that turns out to have been false in multiple senses. One sense is, of course, that the Phillips curve, the trade-off between inflation and unemployment, wasn't vertical in the short term. It does matter, whether through scarring, through longer-term lags, through slowly adjusting labor markets. It does matter what your course of monetary policy is for unemployment. But second, that the issue of independence, just as we've seen with the Supreme Court in the US, just as we've seen with a number of other institutions, it's constrained by the political background you have. You don't make a decision that's going to undercut your legitimacy. And so one has to have more of a realistic view that it is about dialogue with the public, with the elected officials, whether it's the European Parliament, the US Congress, whoever, and with public support. And that unfortunately or fortunately, that's just the reality, that there's not going to be some legislative fix. There's not just going to be you choose your regime and it's an optimal regime. It has to be a form of ongoing dialogue. And that, I also think, is part of the problem, or not problem, but part of the misconception of inflation targeting, which got picked up as you know, starting roughly 30 years ago, and became the dominant factor in the dominant regime. And it was rightly criticized by some people, or not rightly, but understandably criticized by some people as too obsessively focused on inflation. And because economists tended to focus on the target and on the inflation definition. Whereas, at least in my view, inflation targeting was about increasing transparency and getting you to some midpoint between rules and discretion. And so it was part of an ongoing dialogue, and that was how I interpreted the Bundesbank's success, contrary to what a lot of people perceived. So what does that mean for redistribution and inequality? Let me try to conclude with that. So I think we can return to this, but I think the moves that have been made, in particular by the Federal Open Market Committee at the end of the summer, by some other central banks doing reviews to say, we were wrong, or we had gotten too obsessed with the preemptive inflation trade-off, with needing to get ahead of inflation. And so as you phrased it in your question, Filiz, the focus on full employment is important, especially if you do it in an empirically grounded way, meaning you accept the fact that you can't know with precision what U star is, but you know that higher U is better, lower U star is better. And then maybe you should be thinking about things like female labor force participation or differential unemployment rates by race and how the trade-off works. 15, 20 years ago, I raised the idea maybe fighting inflation wasn't a just war, because the idea was you kept sending the same in the US, the same African-American males out to fight the battles every time you raised interest rates. You can't get away from it, but you should realize, like with a war, you don't casually put people out of work. And so this re-emphasis, reorientation towards empirical humility and trying to maximize employment, I think is the right way to go.
Thanks a lot, Adam. This is really a great start on our discussion. I would like to take Olivier's view on how monetary policy can potentially incorporate inequality considerations. As we all know, maybe inequality is an issue that falls more at the intersection of different policies, and Olivier and Danny Roderick look at this in their paper on inequality last year as a result of another Peterson conference. It may be a better addressed through a coordinated policy effort. And in the current context, we see lots of central banks getting into the business of financing governments in response to support their response to COVID-19 pandemic. So I would like to get Olivier's view on some of the policy interactions between fiscal monetary or monetary financial that need to be taken into consideration when we are thinking about how central banks can take inequality into consideration, and what could be some risks, what are some trade-offs in doing that. Olivier?
Good. Very happy to be there. Let me share a few slides. And the first thing to say is that you get two kinds of invitations to speak on Zoom. The first one is about things that you know extremely well, and then it's very easy, or about things that you don't know very well, and then it's harder. But it forces you to think about something you should have thought about. This one is very much in the second category, and the risk is the obvious one, which it implies maybe rediscovering the wheel, but maybe also sometimes, fresh thoughts can be useful. I'm not sure that I'm going to succeed, but let me just try. I have 3 slides. I took my mandate seriously. The first point is that we used to have a view, which I shared, that that basically we didn't have to worry about inequality when we did monetary policy. There was monetary policy, it had one instrument, which was the policy rate. You moved it up and down, and the notion that you could do many things with it beyond just affecting inflation or activity was taken as a non-starter. And then anything which had to do with distribution, well, that was clearly fiscal, because fiscal policy is a much more complex beast with extremely many instruments. So presumably you could take care of distribution effects that way. And I think that was the dominant view, at least was my view for a long time. Yes, separate the two. And if I had gotten your invitation maybe 10 years ago, I would have said no, thank you. But, you know, I'm nice. I took your invitation and thought about it. And I think you indeed are right, that there are interactions. And the point is that I think by its very nature, monetary policy has distribution effects. Because the way it works, even getting away from QE, getting away from COVID, the old days when we use the policy rate up and down, basically what monetary policy does is move the most important relative price in the economy, which is the interest rate or the interest rates, right? And that obviously is going to have major distribution effects between borrowers and lenders, between asset holders and not, and Markus talked about it. And so the very notion that monetary policy works through a policy rate implies that it will have distribution effects. Does QE make a difference? Yes, it does, because you get QE, you get many instruments, and basically you move from a policy which moves the policy rate only to policies which decrease various spreads on sovereign bonds, on corporate bonds, and so on. So by the very nature of this additional set of interventions, you're going to have distribution effects. If you help the corporate sector, who are you helping? And therefore, which workers will benefit more, and so on and so on. So it seems to me that the issue was there even before QE and before unconventional policy, but it's there in stronger form now. So the standard answer that Markus gave, but with the caveats, is the answer we would give when we were asked, but yeah, sure, I mean, there are distribution effects, but, you know, through a decrease in unemployment, if you have an expansionary monetary policy, you're doing more than whatever else you're doing on the distribution side. So even if some workers are affected, you don't have to worry too much because what you're doing is helping everybody. I think that is what we should, you know, reconsider. It's not completely obvious. There are two effects. Maybe one indeed dominates, maybe the other doesn't. And so what I do in the two remaining slides is actually discuss three issues which come up in that context. So the first one is, should central banks distribution effects into account? And I think that my answer is a bit different from Adam. I think that the mandate of many central banks is yes, and basically down the mandate of the bank Adam knows very well, the Bank of England, and it's strong, sustainable, and balanced growth. And you can interpret this as saying distribution matters. I don't know what balance means, but presumably it means something like this. And so it seems to me that it is in the mandate of the central banks to think about the trade-off between what they do to activity, which is the usual way of thinking, and what they do to distribution. And it seems to me that the answer can go either way. So I took two examples. The first one is, suppose that there are only distribution effects. So you decrease the rate, it increases the stock market values, but it doesn't have any effect on investment and not much effect on consumption, because maybe uncertainty is preventing consumers from increasing consumption. Well, in this case, all you get is this distribution effects, not an effect on activity. This is, you know, we can think of this as a vertical IS curve, in which case that shouldn't be the job of the central bank. It should be done through fiscal policy. Basically, there is just no point in having the central bank do it. All it's doing is basically worsening the distribution. So it seems to me in this case, if you care about this, then, you know, the fiscal authority should send checks to people, finance it by debt, and that's the end of that. Another example is, and that's more relevant now, when there was only one instrument, well, you used it or you didn't, but now you have many instruments, and there's a choice. You want to increase activity, and you have a choice between negative rates or decreases in spreads. So you can either just set the rate, the policy rate negative, not too much, or you can buy corporate bonds or sovereign bonds. Then it seems to me that that's a choice which might have the same effect on activity, properly calibrated, but will have very different distribution effects. And implications for the various players are quite different. So in particular, this is not the case for the moment, but if the negative are passed on to depositors, then this will have a direct adverse distribution effect on them. So in this case, it seems to me that the central bank should think about distribution effects and choose one measure rather than the other. There are many other considerations, but this should be in the basket of considerations that a central bank should think about. Last issue, a third example, where it's more less evident what the central bank should do, is now suppose that you're into spread reduction. So you can reduce the spread on those bonds or sovereign bonds or whatever. Then it seems to me that there it becomes much more iffy, because then the political aspects become absolutely first order. It's very easy to see who is helped and who is not. So that I would be more reluctant to take into account if I'm a central bank, because again, it's getting to politics in a way which is too close. I think the other two examples are fairly clear. Let me end with that slide, which is, well, suppose that it has distribution effects and suppose that they are adverse. So you think there is too much inflation, not exactly the case today, and you want to tighten, well, you're going to basically make a number of people worse off. Borrowers are going to face higher interest rates. Well, maybe you can combine money and fiscal in order to get the effects that you want, but protecting the borrowers through lump sum transfers. Conceptually, that works. Now, the practice is that fiscal policy doesn't move very fast. We see this in the US at this point. So the notion that you can kind of coordinate at high frequency is not terribly convincing. Conceptually, I think it works, but in practice, it's not obvious. However, we're in a different place today. We don't have cyclical effects. We have secular stagnation. And basically, we have low aggregate demand, and it's going to last fairly long. It has lasted long. It will last fairly long. In which case, it seems to me that that's a case in which, even if fiscal policy takes time, maybe you can combine the two. So I think that should be explored more. When there are adverse distribution effects and they can be corrected by fiscal, yes, there is room for both. And then the last point is, should central banks further extend their set of instruments? So at this stage, have policy rates and decrease spreads. And how central banks affect the economy, they affect the economy through asset prices or interest rates, not by buying or selling goods. And there's a sense in which it would work much easier. If you want to help activity, you just buy goods, and if you want to slow it down, you sell goods. Okay, so it's tempting. And the issue is, well, there are many issues. One of them is technical, right? Which is, it's very easy to buy goods. It's much harder to sell them. It's not clear what it means. So it's easy to give helicopter money, to just drop it. How you get it back if you want to kind of contract is a bit harder. Helicopters are not very good at that. So it seems to me that's probably a non-starter in most cases. And then there's a very nice paper by Patrick Onahan for the Peterson Institute on monetary policy and inequality. And he says that politically, that basically is outside of the realm of things that can be done. What's known as the Overton window, which is the space that you have politically to do things. So I think it's probably a non-starter. If you actually want to increase demand through, whichever way, then do it through fiscal. Except in one very specific case, which seems to me to be relevant today, is if you intended to help the people, say by dropping dollars from helicopters, and you intended to finance it through the inflation tax, then yes, I mean, basically this is what helicopters. It seems to me that's a very weak argument in practice. And even if you wanted to do this, it seems better to basically send checks to people, finance it by debt. And if you decide that the way you're going to basically eliminate the debt or reduce the debt is through inflation, then the central bank can come later, buy the debt and monetize it and inflate it away. So I see absolutely no point in basically looking at buying goods or helicopter money under any circumstance that I can think of. Good.
Thanks, Olivier. Thank you. So if I understand you correctly, you think that it should be instrumentalized by fiscal policy rather than monetary policy, and monetary policy can come in at a later stage. So because it's more effective doing it through
95% of distribution issues should be done by fiscal. I think that I took this as a given. That's not the job of a central bank. I was thinking about what the central banks do and the implications and whether they can help.
Thanks, Olivier. Thank you. So I would like to, as a current policymaker and one of the global leading global thinkers of our times, I would like to bring Tharman in and ask him whether he would agree with Olivier in the sense that inequality might be better addressed by situating monetary policy within a coordinated policy effort, including fiscal policy. Tharman, can we get your views on this?
Sure, thank you. Thanks. And I'm glad I'm speaking after three excellent presentations. The short answer is yes, I agree with Olivier, but I must first say that I was a little dismayed that Olivier followed his mandate so dutifully, because my experience with all good seminars is that just like central banks, the mandate given to speakers has no predictive power as to what they're actually going to say. So allow me to revert to the mean. I think I'd like to start by taking a slightly different tack, not inconsistent with what's been said, but a slightly different tack, and ask ourselves contextually, what type of inequality are we most concerned about, particularly at this juncture of history? Because the types of inequality we're most concerned about actually differ, and the potential role of monetary policy also differs very much depending on what we're talking about, what type of inequality. In some instances, monetary policy may be part of the solution. In other instances, it may either be relevant or it may even be part of the problem. And we then have to ask ourselves, well, if in fact the problems are so severe in relation to the important inequalities of the time, should we be doing less of monetary policy or relying less on monetary policy, or is there some alternative form of monetary policy that would be more optimal? So very quickly, I think the key inequalities that we should be concerned about at this time, and we all know that COVID has been a particularly harsh recession. All inequalities are bad for, or all recessions are bad for inequality, but COVID has been particularly harsh. And this time around, more than most recessions, we have a very odd phenomenon of a sharp increase in wealth inequality. I mean, wealth often gets destroyed in recessions, or that's what happened to some extent in the global financial crisis. That's what happened in the dot-com bubble burst. This time round, you've had a very strange phenomenon of wealth actually going up for significant groups of people at the top of the ladder, and we have to be concerned about that. But I would like to focus on what I think are the enduring inequalities that we should be most concerned about. First, we have to be particularly concerned about what happens to late middle-aged and older workers, who are the ones who are going to find it, who are already finding it very difficult to get re-employed. And if we just leave it to business of staying outside of employment for a considerable period of time. And we all know that will have a long tail of consequences for not just the atrophying of skills, but for future pensions, for health, for depression, and also, I would say, for politics. Monetary policy clearly plays a role there. The traditional mandate of trying to get back to full employment is still, to my mind, a central purpose, and still has to be there foremost in our minds. Fiscal policy plays a central role, has been doing this year already, both on the demand side as well as on the incentive side. I guess the furlough schemes are both demand and supply, but there's been a very strong signaling and incentive effect of fiscal policy this year. And going forward, I would argue, labor market coordination, which is neither monetary nor fiscal, but involves the role of the state. Labor market coordination, and not just leaving things to the market, is going to be a very important part of the solution to this problem of a large group of people who are late middle age and older being able to get back into the workforce, and ideally with decent jobs. Second, we have to be concerned especially about SMEs. That's the important part of the bottom leg of the K-shaped recovery. There's a very real risk of a wipeout of too large a segment of SMEs coming out of COVID, partly because of the peculiar nature of this pandemic and the lockdowns that had to be enforced. And the services sector in particular has a disproportionate presence of SMEs. This is of concern to us because SMEs also are the largest employer of lower income persons. Here too, I think monetary policy plays an important role, but it's been especially important through what you'd call, I guess, targeted monetary policy, which is these low-cost central bank liquidity schemes for banks and the like. Some of it is quasi-fiscal policy, but I just use the term targeted monetary policy. I think that's been particularly important. Again, fiscal policy has been front and center. There's been a whole range of across-the-board grants. And going forward, I think the need for greater discrimination, both on the targeted monetary policy side, as well as in fiscal policy, will be necessary to allow for some reallocation and to avoid obviously creating a whole generation of zombie firms. So that's a second type of inequality we should be concerned about. It's about large versus small, and we should be concerned about the SME sector and find the right policy mix to deal with that. The third inequality is one where monetary policy doesn't play a role at all, but is ultimately the most important slow burn inequality we're concerned about, which is inequality of opportunities. And that, I'd say, across a whole range of countries, including the most mature democracies, is really an issue that requires deep and hard thinking, some repurposing of fiscal policy, but also a repurposing of social and even residential policies. Fourth, let's not forget the fact that the biggest bottom leg of the K, when we look at things globally, is the developing world. They've been hardest hit, and the poorest countries have been the hardest hit in the COVID crisis. They don't have the fiscal space that the United States or most advanced countries have. We have to be concerned about this, both from a growth and an equity point of view, because this is going to be a major growth opportunity. I can't think of a larger global growth opportunity than infrastructure in the developing world, or investments in infrastructure and human capital in the developing world. It's the largest growth opportunity the world has in the next decade, but it is also critical from the point of view of mitigating what is potentially a very large inequality going forward, with consequences which will obviously not just be economic. And finally, intergenerational inequality. We are facing the biggest intergenerational inequality we've ever known, which is climate change. And on the last point I was making, I should say that global monetary policy matters. Using the innovations and initiatives within the international monetary and financial system are critical for that whole issue of global inequality, and particularly making sure that the developing world doesn't submerge. Coming to climate change, it's an issue where I can't think of a meaningful role for monetary policy as such. It's all fiscal or global public goods, and we know what needs to be done. So coming back to Olivier's question, which he put very squarely, there's some inequalities which have to do with employment and wages and incomes, particularly at the lower end of the ladder, where we know that monetary policy can do something by raising the level of activity and heating up the labor market. And we also know, as he's pointed out, that there are some distributional consequences which go the other way, mainly because monetary policy is, particularly when you're at the effective lower bound, is operating largely through the asset markets. And intrinsically, we do have a wealth distribution issue coming out of the very functioning of monetary policy. So the question which Olivier posed to us is, how do you address that trade-off? And I would say, and I'm saying this in a bit of a stylized way, but I would say that as we are now at the effective lower bound, the balance between that ability to boost activity versus the negative effects on distribution does shift. And I would say that not just going forward, but I'd say that actually even in the short term. I mean, monetary policy was critical in stabilizing financial markets. It was absolutely critical in restoring liquidity, both nationally as well as globally. It was critical in forestalling panic. But I'm not sure, honestly, I mean, it'll take some time for us to have serious empirical work on this. It's very unclear whether monetary policy has, even in this COVID recession, had that much of an effect on activity, as distinct from the massive role of fiscal policy and just government transfers alone. But we do know it's had an impact on asset prices, and with very predictable implications. So I'd say even in the short term, we need to have some circumspection as to what's been happening, but more so in the medium term, because the longer we stay at the current setting of monetary policy, and the longer we have to rely on the asset markets as the route of transmission, the more that this trade-off which Olivier posed us will end up on the wrong side. And we do have to be concerned about that. Now, we are able to say this because we do have alternatives in fiscal policy. Monetary policy will have to remain accommodative for a while. I mean, there's no doubt about it. But the heavy lifting is going to have to be done on the fiscal policy side. Heavy lifting to defy secular stagnation, if you're thinking of it medium to long term. I don't see a meaningful, I mean, we just don't know enough now to be able to formulate alternative monetary policies that can somehow address that trade-off differently. We just don't know enough even about the direction of the sign on many of these things. And there's too much ambiguity on the way in which monetary policy impacts on different types of inequalities. So if I take Markus's point about different types of different spreads or different duration of bonds, and the fact that, yes, there are different groups of investors holding these instruments, that's true, but we are going to find it very difficult to be time consistent. And there's going to be too much uncertainty in monetary policy. So I'd say we just don't know enough at this point. So to my mind, the interesting question then is, in this mix of monetary and fiscal, with monetary remaining accommodative for quite a while, what do we do on the fiscal side? And I'm not going to elaborate on that now, but there is a relation. There is a way of framing this that I think has to force our minds, which is, first, how do we make the best use of a low interest rate, low funding cost environment? It may not be there forever, but it's there for a while to come. How do we make the best use of it for fiscal policy to engage in growth enhancing investments, to tackle climate change, and to tackle the inequalities of opportunity and the problems of social mobility that are our biggest problems, right?
Yeah.
And second, given that monetary policy is going to remain accommodative for quite a while and is going to continue to have its inefficient transmission, I would say, through the asset markets, what does that imply for fiscal policy and the degree of progressivity that we need in systems of taxes and transfers taken as a whole in order to offset that inevitable impact on inequality, particularly wealth inequality? And this may not be simply a matter of wealth taxes, although it probably does involve some form of wealth taxes, but we really have to think in terms of the overall progressivity of fiscal policy, which is now given greater import because monetary policy will have to be what it is for quite some time to come. And finally, I just say that, there's an opportunity in the new zeitgeist that's been created by COVID. People no longer look down on public goods. People know that there's some benefit that comes out of public-private collaboration and projects, or even private-private collaboration, which has been a very impressive part of vaccine development. So let's use the zeitgeist to be able to think hard about the types of investment we really need in the future. How do we take advantage of a low funding cost environment and do the big things? I'll stop there.
Yeah, thank you. Thank you so much, Tharman, for this comprehensive discussion. I would like to get into some of the questions. Sorry. Oh, can you hear me? I think.
Yes, we can hear you, Filiz. Please continue.
Okay. All right. So I would like to move to the questions. Some of them have been already answered by our exceptional panelists. So the first question relates to the fact that we tend to think of the link between monetary policy and inequality in terms of savers and borrowers. I guess this goes to Markus's work, and it's asked that this seems like a very unequal decision, and how it could be addressed, given that low interest rate environment is affecting borrowers and savers separately. And in relation to that, there's another question which I find very interesting, that although we tend to think in terms of savers and borrowers, there is a part of low-income households or younger generations who wouldn't be in a position to get a mortgage, or they lack collateral, or they don't have a stable job. So how do we see the role of monetary policy for these segments of population? Maybe I can start with Markus and then move to Adam. Markus?
Thanks a lot, Filiz. So I think that's very nicely put. Of course, when you do monetary policy, you create capital gains, and you decide when do you create the capital gains. If you cut interest rates now, you create capital gains now for certain parts of the population. If you cut interest rates later, or hike it later, you will change it later. And one problem, I think, which is with any inequality measure, and Tharman mentioned several of these inequality measures, is that they're snapshots. While monetary policy is something over time. And then the big challenge is to what extent you create essentially capital gains now, and what extent you can create income effect. So let me just give you an example that, let's suppose you have a certain job, you get a certain stream or certain asset which gets you a certain stream of cash flow, you cut the interest rate, and nothing happens if you don't sell the asset. It's just you get huge capital gains, but you're suddenly more wealthy. You can live in this nice house, you get a certain utility stream or whatever, but it doesn't make you more wealthy in a sense. So the question is, if you measure wealth inequality, it's very different from measuring income inequality, and these are challenges here. But on the other hand, if you have capital gains and liquidate them, they translate then into income directly, and can use it for some other purposes. And that's, I think, makes the whole thing challenging, having snapshot measures rather than some dynamic measures. I don't think we have some good dynamic measures. I would like to come back also to what Tharman said on this equal opportunity. For me, and I think I very much echo what Tharman is saying, is that equal opportunity means great job opportunities, jobs, and jobs. And we know from some recent work, that jobs come back slowly after the recession is over, and then it grows at a cycle. Like Bob Hall had some recent work showing that actually you have job growth always growing at the same rate, essentially, until the next crisis hits. So there's no natural rate anymore. You get the job growth going and going, and then there's a crisis, and then suddenly the unemployment shoots up until the whole crisis is over, and then you have job growth again. So essentially monetary policy, to a large extent, in order to create equal opportunity, is to avoid crisis. So in particular, the buildup of risk, which then materializes in crisis later on, and then destroys jobs. I think that's very, very important. One should not forget this main insight. You also mentioned, so Olivier also mentioned, there might be some smart ways to helicopter drop, and he was skeptical about this. So let me add another skeptical, even more technologically driven example. Like in China, in Hangzhou, it is the case that they give out smart coupons. So you essentially do a helicopter drop of smart coupons which expire. So you have to spend them. You can't save this away. And you can even specify these coupons, what you have to buy or what group of goods you might choose it from. And this might be a way to have a very smart helicopter drop. I'm very skeptical that this should be the way we should go because, you know, I like the freedom of individuals to choose rather than the government determining you should buy red shoes or blue shoes or whatever. But in theory, going down the road in the future, governments will be way more powerful to fine tune and target consumption spending within a certain time window and within a certain product class. And I think that's a new way of doing helicopter drops, or fiscal, could be fiscal or monetary, which I think is more distortive. Of course, it gives the government much more power, and I think that's what has to keep in mind. And with this new technology, coming back to Adam's point, is more and more important that the central banks stay then within the mandate and don't, you know, say, okay, now we do a helicopter drop that you can buy only red shoes. Let's say that would be very much might be stimulating because of certain industries and difficulties, but it's very much beyond the mandate, I would say. So we need a more clear definition of the mandate, going back to Adam, which goes beyond the time consistency perspective. But, you know, much more, how much are these central bankers elected from the public, the sovereign, the public, and to what extent, you know, we have to keep it with the policymakers who really get the power then from the people to make these decisions, how to redistribute and whom to help out and whom we don't.
Thanks, Markus. So moving to Adam, just to repeat the question again. So what we could do for lower income households or to stimulate low wages? For example, do you think that the recent revisions to the US monetary policy framework is somehow responding to the inequality issues by focusing more forcefully on unemployment objective? Adam?
Yeah, thank you, Filiz. And again, thanks to my colleagues for their comments, and especially Markus for echoing or advancing, frankly, what I was saying about the time and consistency perspective. I think you're right to focus us on this question of wage growth. And so with no disrespect to Tharman and Olivier, these longer term issues of optimal institutional design, essentially, and how we work the fiscal policy and coordination are in the short term second order. I realize that that's not their main point, and Tharman very forcefully talked about the need to respond to the pandemic's special attributes. But so I want to go to two pieces of your question, one of which builds directly on Markus's last point. So the first point is that one of the dirty little secrets of central banking for the last 30 years has been that they've been de facto wage targeting, or at least they were until secular stagnation came in. Because you would say, okay, we're targeting an inflation rate, but anything that's a supply shock or a one-time shock, we look through, we don't raise rates. We only raise rates when there is a sustained pass-through, a second round effect. Well, how do you determine the second round effect? Well, generally, the second round effect means it's passed through in wages. You almost never see a second round effect that's meaningful that isn't passed through in wages. And so though the central banks never admitted this, most of them were doing this. And in an environment where the capital share was going up in the economy year after year after year, particularly in the US, but in most advanced economies and in some emerging markets, this meant that you were essentially validating or at least enabling that transfer of income. Because if you ever saw a gain in wages, you would say, oh, that's inflationary, even though it might have been at the expense of redistributing the pie rather than being inflationary. It might have been a one-time shock. And I don't want to suggest that there was some conspiracy here. I'm just saying that I started worrying about this when I was at the Bank of England a decade ago, that this is de facto where people ended up. And so I think the central banks moving away, rebalancing towards issues of full employment and issues of distributional employment as things they should focus on and talk about is a way of getting out of that trap, because you need to make some kind of qualitative assessment, case by case. Is this rise in wages because of a just as justifiable redistribution as it was capital taking a larger share all these years? Labor may be allowed to take a larger share. You need to face some way of doing that. But the simple reality is, in rich countries, and this is something Olivier and I wrote about on Japan several years ago, is that unless you have a currency crisis, basically you can't get sustained inflation without wage growth. I mean, can't maybe slightly overstrong, but pretty much. The second point, picking up on Markus, is when we start talking about all these clever fiscal things that we can and should do, and I don't mean to dismiss my colleagues' creativity, because it is important to think about these targeted new fiscal ways of behaving. There is this question that Markus raised, and you implied, Filiz, about what is the role of the central bank. And the reason I was talking about the mandate as not being that important isn't, as Olivier says, I mean, the mandate does matter. It ultimately is the voice of the elected officials. But in practice, mandates are always going to be unable to keep up with changing times and are going to be vague. I mean, Olivier read out the Bank of England mandate, so the issue is when you're doing fiscal monetary coordination, how much should the central banker be talking? How much should the central banker be advocating? And again, we had decades of central bankers giving lectures on fiscal probity, and that led to an environment where the ECB, at least initially in the Euro crisis a decade ago, was very reluctant to cooperate with fiscal authorities. And again, this is something that's there's not going to be a design fix. It's not going to be something one and done, but that there has to be something in the mandates that recognizes, or a reinterpretation of mandate, that recognizes central banks can voluntarily decide, yes, I am going to coordinate with monetary policy. And the question is, how do you put rules on that so that it's not just, okay, Janet Yellen or Jay Powell has more of a bleeding heart about unemployment than Alan Greenspan or Paul Volcker did, and therefore we get coordination. Or, we have a crisis and so they coordinate, and then in the crisis they don't coordinate. So that's where I think the research has to go. But the main point of these two things is going back to something I think all my colleagues said, is while these distributional issues about differences between savers and borrowers matter, the vast bulk of the action in inequality and in human terms is about people who lose jobs and don't recover, people who lose income for a sustained period or wealth and don't recover. And that's why I keep bringing my comments back to employment stabilization, because that goes with the short-term focus of most monetary policy, that goes with the more limited mandate that you're not getting too specific, and frankly, it goes with the biggest need, in my view. And if you start getting too much into the rhetoric and the technicalities, you have to do it. But if you get too caught up in borrowers versus savers, equity holders versus debtors, you're getting into something that's not actually that material for the bulk of people in the society. And it gets you into micromanagement that I'm not sure the central bank should be in.
Thanks a lot, Adam. So in the going with in the direction that monetary policy could perhaps be most productively contribute inequality through its impact on employment and protecting, providing stability, macro stability in terms of employment. I would like to go back to Olivier. Can we provide additional space for monetary policy making to focus on full employment policies? For example, can we make it more potent, for example, through increasing inflation target as you proposed a while back? Do you think that's a good way to think about how monetary policy can more positively contribute to full employment? Olivier?
Yes, thank you. So, given that Tharman told me I should not respect my mandate, that was a major mistake. So I'm going to actually take up some of the points that came up earlier, because I think that a few remarks to be made. On the borrowers-savers issues, I think that's actually a very important issue. I disagree with Adam. There's actually some irony, which is that if you have a pay-as-you-go system, it's not the end of the world if interest rate is low it's much more of an issue if it's fully funded, or if basically people save for their old age, which is an interesting twist on the notion that we should try to fully fund the systems. It actually makes them much more exposed to distribution effects. So that's a kind of half a remark and half a joke. And I love the idea that I think Markus mentioned on these expiring coupons. It could be fiscal, and there's no reason it should be monetary, right? I mean, this is still, but the idea that basically you get the intertemporal substitution because there is no alternative is actually a very nice one. And I had not thought of this. Maybe there's something to be done there. On the issue that Adam raised, Chris Erseg, one of your colleagues, and I have worked on wage inflation targets rather than price inflation targets. And we focused on the effect in terms of stability, in terms of the efficiency of policy using the usual criteria, but it has different implications in terms of distribution. So I think you should go back to it and do what we didn't do, which is to look at the distributional implications of having a wage inflation target or a price inflation target. I think that it actually makes a difference. On your question, to which I now come, your last question. Yeah, I mean, obviously, I'm totally in favor of a dual mandate. I've never thought that inflation was such a, the goal. To me, as you probably know from my work, I've always thought of inflation as a signal that output is roughly at the right level. I don't want 10% inflation, but I don't care very much about stable 2% or stable 4%, except that indeed 4% gives more leeway. So to the extent that you want to give as much room for monetary policy to help for the usual reasons, forget distribution, then clearly I think 4% is better than 2%. And if we'd had this in the past, we'd have a bit more margin. So I continue to think that 4% is a better number than 2%. It's actually twice as good, roughly. But, I'm not going to push for it now because at this stage we have a hard time getting to 2. So my attitude there is let's get to 2 and then we have a discussion again. Let me start there and give the floor to others.
Thanks a lot, Olivier. So Tharman, in 2017 in Rethinking Macro Conference, you presented some out-of-the-box thinking on education, or rather the form of education. So what do you think that some of the longer run scars or opportunities by the current crisis that can alter the landscape or debate going forward on inequality, or how we should think about it more broadly? And also, of course, in the context of monetary policy, what can monetary policy do in trying to mitigate the longer term impact of the crisis on inequality? And there is one question that I thought, if we have time or if we can quickly touch upon, on the global implications of inequality. How much, of course, with the current crisis, inequality in advanced economies is increasing, but much more so in developing world, given the structure of the economies or some other structural issues, and the limited policy responses given the fiscal space issues in developing world. So how much we should worry about global inequality as a central banker in advanced economies? Thanks. Tharman?
Thanks. And by the way, Filiz, I should apologize that I missed your earlier summary and questions because there's some problem with my sound system, but I caught on when Markus started speaking. Maybe just to broaden your question and go back to something which Adam was saying, I think we need a lot more research and debate on the longer term consequences of monetary policy. The traditional paradigm is that monetary affects the nominal and not the real. It affects the short term and not the long term. But there's so much blurring now. And I think there are a few issues which have just come up. First, on what Olivier and Adam were discussing, on the whole issue of pension funds and life insurance funds, I would say the longer we persist with holding interest rates ultra low, the more we're going to be building up a real problem. First of all, insurance funds, as distinct from the defined benefit pension schemes, insurance funds are hit in a very straightforward way when interest rates come down. They're hit on both the asset and the liability side. On the defined contribution schemes, clearly Olivier is right. And I would say there, we have to do some hard thinking about the way in which we organize defined contribution, because we're all very familiar with the American 401k type schemes, to some extent the Chilean model and other models. And they were all models that were not just about defined contribution, but about market-based decisions by individuals on their own, as distinct from some way of collective management of funds within a defined contribution scheme. And we conflated the two things when we moved away from defined benefit. We conflated the two things and thought that defined contribution means that each worker has to manage and make decisions on their own as to which 401k to choose. And it's worked out pretty badly. And particularly now in an environment of low interest rates, I think we need to think hard about how we have collective management with very simple choices, if at all, given to ordinary people, given the very strong evidence that you can't put the risk on them to manage their retirement funds. Second long-term issue is productivity. Again, we don't understand this very well, but I think there's a reasonable case to believe that if you keep interest rates at a totally non-discriminating level, you're not going to be able to get capital market efficiency to work very well. And we already see in Japan and Europe and some other places, we already see the emergence of a lack of reallocation of resources away from firms who are just limping along because the cost of funds is virtually zero. So it's a very serious issue. Third issue is the long-term implications of the search for yield and the financial stability implications, in other words. Now, this is a bit more conventional, and central bankers are discussing this. There's a range of macroprudential policies that are talked about. Still a very imprecise business, but we at least know how to think about it. But the search for yield internationally is still an issue which is not very well addressed. The implications of domestic monetary policy in the largest economies for the search for yield internationally, and in particular for the volatility of capital flows, is still an issue which we know descriptively that there's a problem, and we don't have a very good solution for it now. I believe there is a case for the IMF and some other bodies, including the BIS, but principally the IMF, to be able to mitigate this and to have rules of the game that can lead to somewhat greater stability, but that's another topic by itself. But coming back to the point Adam was making about wages and the way in which monetary policy's role with regard to jobs is still so central. I agree, not just short term, but even when it comes to the longer term institutional factors that have led to increased inequality. If we think monopsony in labor markets is a problem, and clearly it is in many labor markets, if we think weakened bargaining power is a problem, there is a case, and Alan Kruger, in fact, made this point in the 2018 Jackson Hole Symposium. There is a case to say that if you're able to keep employment as much as possible at a full employment level, you're better likely to be able to strengthen bargaining power of workers who are not, including in non-unionized sectors, and also weakening the monopsony power of employers. So I think that's something that requires more thinking and more work as well. Finally, I would say that one of the longer term issues coming out of COVID that we now have to factor in, which Ken Rogoff has pointed out as well, is that we're very likely to see just heightened unease in the population for a long time to come with the result being higher savings rates. It happened after the Great Depression. It just changed lifelong behavior. And it may well happen again now, and it'll accentuate the whole savings absorption problem that we have. So just thinking about the longer term consequences of traditional macroeconomic policy is an under-researched area. And even if we don't have very clean and simple answers to it, we have to, at least in a stylized way, start factoring it into our policy making.
Thanks a lot, Tharman. So we only have 4 or 5 minutes left. So I would like to connect again to our theme of this three-day event. In the first one, as I mentioned before, we discussed what can central banks do in terms of financial policy. Then we discussed financial infrastructure, touching upon the issues of digitalization, financial inclusion, which is particularly important in developing countries, but also in advanced economies, particularly in the US. And now we are discussing monetary policy. I would like to get your views very briefly, whether you think central bankers, even if they would like to touch upon, incorporate more inequality concerns, that among the functions of the central bank, which ones do you think are more appropriate to address these issues? Maybe I can start with Markus and go through our panelists very quickly. Markus?
Yeah, so I think the central banks, as Olivier pointed out, should have an emphasis on balanced growth, and that's, I think, very important. And they should be flexible what instruments they're using, but it should be very clear what they're doing in a very transparent way, and they should stay within the target. So it should not be seen as favoring one group over the other group. Of course, to the extent that, you hurt the whole savers, high inflation wiped out in the 70s the whole middle class, essentially, in the UK, in the US. You don't want to get this on this sense. It's very important that you keep the main target of price stability in your focus, that you make sure that there are enough jobs. That helps probably the poor the best. And then you, as Tharman mentioned, also put the pension fund situation in the game. So you have to have a multi-pronged approach. And for each of them, there might be a different instrument, which is the best one. But it should not be seen as the main objective of the central bank to do redistributive monetary policy. This should be done by the elected leaders who, have a backing from the populace, from the population, from the sovereign, essentially.
Thanks, Markus. Thank you. Adam, do you see any role for financial supervision policy or inclusion in alleviating inequality considerations?
Yes, I do, Filiz, and basically I completely agree with what Markus said, so I'm not going to add anything to that. I think the financial, just as many people make the mistake of thinking about the global or North Atlantic financial crisis a decade ago as being a failure of monetary policy, when it was really a failure of supervision and regulation. I think similarly, the action that central banks can take on redistribution or on inequality is primarily in the financial regulation supervisory space. And I know we've had 2 prior sessions with distinguished panels in this series on that. But just to say, part of it is crisis prevention. All of our colleagues have spoken about how damaging crises are. Part of it is to make sure that small savers and small borrowers are not exploited. And part of it is to do things which particularly are true in the US, but there are analogous things in other countries where you're exposing things like redlining of mortgage markets, where you had racial discrimination in mortgage markets. Federal Reserve Bank of Boston did a huge amount of important work on this, for example. Federal Reserve Bank of Minneapolis now is doing work on various things to do with housing. Federal Reserve Bank of San Francisco has done research on divided labor markets. There is room for both research and financial supervision together to make a material difference. And we shouldn't, today's panel was focused on monetary policy, but you're right, Filiz, we shouldn't let it just go to that.
Thanks a lot, Adam. Olivier, is there anything that you would like to add as we're finishing today's session?
Two things quickly. The first one is I agree with Markus and Adam that regulation supervision is probably where there is the most to be done. In terms of monetary policy per se, what I would like to see is basically whenever a measure is taken or a new instrument is put in place, that there is some analysis of the distributional implications. Whether or not it leads to a different decision, I think that information would actually be tremendously useful, and we can probably do a decent job doing that.
Very good point. Thanks, Olivier. And Tharman, is there anything that you would like to add for today?
Well, I think whilst we do not have a framework or confidence in a strict coordination between monetary and fiscal policy, the broad strokes are clear enough. The need for fiscal policy to think hard about social and economic returns for every form of fiscal spending is clear enough. Low interest rates may not be here forever, but we've got to think hard about returns. We think so hard about central banking and think so hard about monetary policy, but there's just so little serious thinking in fiscal policy about fairly basic precepts. What are the economic and social returns to each form of spending? Second, the point I mentioned earlier, broad point, given that monetary policy has to be where it is for a while to come, you need to have a sufficiently progressive system of taxes and transfers overall, and it has to be designed in a way that's still supportive of and catalytic of growth. That's a principal objective. It's jobs and growth. And it can be done. And that's, again, a broad point. It doesn't require very clear coordination between monetary and fiscal policy or treasuries and central banks, but that broad point is, I think, fairly obvious. And third, I would just repeat a point I made very briefly earlier, which is that there's some things that you can get for free, which is coordination. Coordination is a real asset. If you can do coordination well, particularly in job markets, and particularly in the environment going forward, where we are going to get more reallocation of jobs in the economy, because a significant chunk of old jobs aren't going to come back, and people are going to have to switch jobs, not just within the industries they're familiar with, but across industry. It requires coordination. Coordination on skills upgrading, coordination on SME upgrading, coordination to make sure that when people move, they don't lose all the human capital they had in their previous jobs, but you find a way in which they are augmenting what they have. It doesn't happen without coordination. And systems which have coordination between government, be it federal or typically local, employer federations or industry groups, unions or other social partners, and very importantly, the colleges, or training providers. Those systems that do it well are going to get something for free. It doesn't cost something on the government budget. I mean, there'll be some incentives, of course, but it's not about the size of your fiscal deficits per se. It's about coordination in a market economy. And I think that's going to be even more important going forward. Thanks
a lot, Tharman, and thanks other panelists too. Indeed, one of the questions, we have gotten several questions on this issue. But mostly on the fiscal side, there were a couple of points made in the chat box that perhaps in more broadly, if fiscal policy is more active in addressing rich poor separation, perhaps central banks would have less of a job in that regard. But given where we are, it's always good to think about what we can do from different institutions and also in central banks. And today we really covered the broad range of issues. I would like to thank again for all of you, Markus, Adam, Olivier, and Tharman, for joining today. I tremendously enjoyed our session, and I would like to end this with this note and take care. Bye.
Thank you, Filiz.
Bye.